This is Cece. Welcome to the Orbit. It is Thursday, March 16th. We've got stocks basically unched today. We were a little higher early in the morning. Stocks basically have pulled back about to unchanged. We're just above that 5,300 level. And we're going to get into what's happened over the last couple of days. We ramped up a little bit in short duration vol into the CPI, not that much. We had a strong move higher yesterday on the CPI, which is actually a little bit more than what options were pricing. You can see that sort of consistent grind higher yesterday. We finished up a little bit more than 1%. Options were pricing about 0.8%. So there was some short duration volatility, implied volatility in the options going into the CPI. It has collapsed, absolutely collapsed after the fact. And if we go out to the 1 month chart on SPX, we can see what I am talking about. We are at just, for tomorrow, we are at 11 IV right now. And for Monday, we are in single digits. These are as low, basically, as you're ever going to see SPX volatility. So this is the weekend effect. Monday options tend to compress into Friday expiry to account for the weekend, but seeing something that it's 8 vol at the money, you just don't see that often. And that actually goes out to Tuesday, Wednesday, picks up a little bit Thursday, up to 10. That's the backdrop for the market conditions, the long gamma of dealers around these levels. Most people are selling options. They are long the market. That creates a kind of condition where sell-offs get bought. Rallies are very slow and orderly. The pressure a lot of times is to the upside. So if you're selling options, you oftentimes have to be careful about the market sort of lazily rallying through your upper strikes. It's possible for the market to just hang out at 5,300 for a couple of days. We saw that last week where we basically had 3 to 4 days of the market basically going sideways. That was this around that 5,200 level or just above that 5,200 level. Then we had the CPI, boom. Now we're at the 5,300 level. It's possible we go sideways, possible we grind higher. What it would take for the market to reverse and vol to spike in any sort of significant way, not just down 0.25% red day. It would take some sort of change in the underlying components of the market. And if we just go into TLT, we've been talking about TLT since we were down at those lows in the market just a couple of weeks ago. And if you look, it's a very similar chart in TLT. Right down here is where the SPX bottomed. TLT has climbed higher. We've talked about how important that 90 level in TLT was and whether it would hold that 90 level as we kind of traded right around that towards these lows in TLT, these multi-month lows in TLT. We are up above 90 pretty significantly. The sell-off in the market over the last month, that has eased and has taken pressure off of stocks. The other thing that was putting some pressure on stocks, which was hand in hand with inflation worries, was USO. Now, if we back USO out a little bit, and let's just go to the 3-month chart, you can see it's up today, and it's actually up over the last couple of days. But you can see that top tick back here in April. And this was, again, very close to those market lows. Treasury yields come down. You're seeing oil come down. You're seeing TLT go higher as a proxy for the bond market. And you're seeing stocks go higher. And that's the backdrop. As far as trading, let's start with SPX. And let's talk about option selling, especially 0DTE and short duration. The story is the same. We are looking at a 1-day chart here. We have an expected move of about 0.25% for the rest of the day. That is 18 IV, which is pretty low for 0DTE IVs. A lot of times you see 0DTE north of 20, even if the next day out is 12 or 13. In this scenario, we've got 0DTE vol at about 17 and tomorrow at about 11, almost 12, and that is Expiry Friday. Expiry Friday, all of those effects of gamma get their even stronger effects because you have all of the single stock names that perhaps dealers are long gamma. You obviously have SPX, SPY, Qs, things like that. And that can put some extra pinning effects of that gamma, because as you get closer to a big monthly expiration, which tomorrow is, those effects of gamma, as options get closer to 100 deltas or 0 deltas, those effects of gamma and those pinning effects can become stronger. And from an option selling standpoint, the conditions are perfect for small market moves. Again, we have basically an unchanged market. Every day recently, except for this 1% rally on the CPI, has been a market that has not moved. If it gapped lower, it tended to find buyers. If it gapped higher, it would at least pause, or if not, find sellers. A lot of sideways action, a lot of slow creep higher. You have the CPI, which sprung it up to that next 5,300 level. And here we are, and going into Expiration Friday. So from an option selling standpoint, the market is behaving. But at the same time, you have to be aware of these low IV levels that one would be selling. Now, going to an iron condor, let's go to one expiring tomorrow for Expiration Friday, and let's just look at these strikes. We've got 53.35, 52.85 at the expected move. You can see just how close that is to the money. So these options are pricing pins and sideways action. So therefore, if you are a seller of options, you have to be careful about the entry timing in the market. So this morning's a great example. Is you had an opportunity here if you wanted to sell credit call spreads to perhaps get them at a higher strike or more premium. And then the same is true if we were to go red here. Perhaps that's a chance to leg into something a little bit lower. Otherwise, you basically need the market to go sideways. You can obviously go a little bit wider. Let's take this a little bit wider and see. But you're going to see when we do this, and now we're getting a little bit more room. Let's get this up to above 53.50 on the upside and down near 52.70 on the downside. You can see how quickly we are to that 4-to-1 risk ratio. Although that's the backdrop of the market, is the market options are pricing, they're not pricing for gaps or even overnight at this point. And outright directional plays, we talked about this last week, looking out a month or 2 or 3 for those looking to position directionally. Even this market move higher this week, you would be getting close to break evens had you done a call spread in SPY or Qs, even out a month, because the break evens are so tight on a debit call spread or a debit put spread. If you're looking at debit put spreads here and going out we're at a 3-month chart, going out to even August, down at about 506, that is nothing on this chart. We were at 506. That's about halfway of this move. So you could go out to the end of the summer and get hedges down towards, with break-evens well above some prices we've just seen in the market. And the same is true for breakouts. Like if you were looking for IWM to break out and this interest rate story to continue, you have very low volatility going out even 3 months, going out well into the summer in August at of like 222. And that is taking you back up near the highs. You could do a call spread back up to the highs in IWM if you were bullish. If you're bearish in the market, Qs, IWM, individual stocks, you can put on very inexpensive hedges if you look out a couple of months.